There was a transitory confidence shock, no question about that. We saw it in things like capital spending plan surveys, but they've rebounded in March, which implies when we are looking at these core capital goods orders in 2 months' time, they should be considerably stronger. However, some perspective on all this, inasmuch as the decline that we saw in November and December was 20%. The median decline in a stock market related to a recession is 21%. That's since World War II. So the market priced a recession. And as you just said, Steve, this was a fairly shallow slowing of growth for a period of time. And a lot of the confidence indicators look like it's reaccelerating. So we way overshot any slowdown, and the market is pricing that. I would also add that that decline that you just described in the bond market is quite symmetrical to what happened to the stock market in the aftermath of the December FOMC meeting. So our note right after that we wrote was fade the Fed, that the market took Fed assurances, which they didn't really provide, that they weren't going to raise rates for the better part of a year or again this cycle, and overshot it. The stock market dropped 6% after the December 19th meeting. If you chase that, you got caught in at the lows because it turned around and rallied 20+% since then. So we're making the same argument with the bond market right now, that the bond market rally was far more attributable to Fed policy expectations rather than the economic outlook, and that you shouldn't chase it. You should actually sell treasuries here, and that you are likely to get a significant reversal as that economic outlook improves over the next few months.
So how much is left for the markets, then, the stock market?
I think we're going to new highs. We should get through 3,000 fairly easily. I mean, that's been our analog or our picture for the entire year. Is this is much like 1988, where we had this almost crash in the fourth quarter that really was not associated with any leverage. It really was not a harbinger of a recession like 1987, right. And that 88 would look, or 2019 would look like 88, and we would go to new highs through the course of the year.
Will there be a down quarter in earnings? Will the first quarter, will you have a year-over-year? No. What about second quarter?
No.
So there will not be a down?
No. A revenue growth is going to stay around 5%. Right. You'd have to have just historic compression of margins. There's no indication that that's happening. There's some sectors with margin pressure.
A guest on earlier said we had an earnings.
Well, earnings recession doesn't necessarily mean down. That's what people mean for. Right. That's why I asked him to define.
He was talking sequential.
No,
I heard the interview.
Yeah, sequential or right. Deceleration.
I don't think even on a year-on-year, when you get finished with the typical positive bias, and by the way, those estimates haven't been falling for more than a month, you'll wind up with something marginally positive in the first quarter, more positive in the second, and something closer to a 10% run rate in the second half of the year.
Barry, I don't want to let you go without this getting on air, the conversation that you and I have in the background on the issue of the tax cuts and spending. And you have a different way. You've turned me on to a different way of looking at this, which is stop looking just at the equipment, but look at the intellectual property. And you think that's an outgrowth of the tax cuts. And that's done quite a bit better than equipment. And that makes sense to you, given how the law is. Folks, we have a chart in the background. There it is. Now, watch what's happened here. Over the last, it's 2017, equipment did better than intellectual property. A lot of oil probably in there, the rebound in oil prices. And now, curiously, equipment's come down since the tax cut put in place, but intellectual property has come up. Without getting too geeky, is there an investable thesis off of this? Is there something that you that underpins an investment thesis?
Absolutely. The tax bill changed the effective rate for equipment only very marginally, but significantly lowered the effective tax rate of investing in software quite significantly. And we saw a boom in software and research and development investment, and that's likely to continue. So continuing to invest in enterprise technology, the Internet of Things, software investment. I get that those stocks have performed significantly, or outperformed significantly, but the underlying core momentum there is quite strong, and it does look like the tax bill really did what it was intended to do, which was to boost those categories.
And then you get a pop in productivity, perhaps.
We've already seen it. It went from 1.1 10-year trend to 1.8 last year, and it should follow on further. And that anecdote I always tell people about this is it's now service sector companies that are finally investing in substituting capital for labor. Try and pay a human being for a cup of coffee in Terminal C in Newark Airport. You can't do it, right? So they finally ran out of bodies, put iPads everywhere, and they are starting to drive productivity. And you see this in the performance of restaurant companies, which have continued to have margins expand despite labor costs going up.